we're going to do kind of a high level overview, as we do, talking about the market, talking about different segments of the market, and talk about what's happening, a little bit about inflation, a little bit about luxury. So we're going to touch on sort of a lot of different elements here. And I hope you are as excited as I am. Stats are fun. Okay, I kind of did this last time, and forgive me, I didn't have a chance to get a new funny one, but I always like to start with kind of an interesting fact that gets us thinking. So our fresh water is so old that statistically speaking, every time you drink a glass of water, that water molecule very likely passed through the body of a dinosaur. Pretty cool. Okay, the market. So showing activity. So this is one that we watch weekly. This is so key to everything that's happening in the market because it's a leading indicator, right? So what does that mean? Well, it's kind of the thing before the thing. So before we see, any increase in demand or closings or signed contracts, what have you, we first see an increase in showings because that's that leading indicator that demonstrates buyer interest, right? So, I won't go too deep into the trend here, but just know, here we are, 2021 for another couple of weeks. You guys can see just how strong showing activity was compared to 2020 in dark gray, where we saw showing activity really took a dip after COVID arrived. You can also see 2020, we made up a lot of those losses here with gains here. And although, here in 2021, we're kind of back on trend with 2019 and 2020 levels, we were ahead for so long, and that's really helped us on the demand side. Let's see, Ruth, yes, you are all muted, I'm pretty sure. Yes, you should be, okay. So that's kind of just a word I'm showing to you guys. Let's just keep on that topic for a little bit longer, another minute, and just think about, showing activity is not some monolithic thing, right? It happens across a price spectrum. So one thing to sort of think about is what's happening regarding change in showing activity by price point, and how does under 200 or under 300K, our affordable segments, how does that contrast with, 800 plus, million plus, or some of our luxury segments? So be careful here. I always like to mention this is 2-year change, at the beginning of in January. So in a month, I think we're going to get back to, back to year over year. We'll look at it and just make sure that, we're not doing an apples to oranges type comparison. So you guys can see in our most affordable segments, that's where we show the losses in, in tours and showings. That's where we see the declines. Where we see our gains, and some of them pretty notable gains. This looks like a 70% increase in market share. It looks like pretty similar here, in our 3 to 5 ranges. So, as much as I kind of hate to say it, 3 to 400 is kind of entry level now. Maybe 150 to 2 used to be, then it was 2 to 250, then it was 250 to 3, and now it kind of seems like 3 to 350. Could be entry level for a lot of folks. So you see those gains in what I'd call some of our mid-market ranges. Some of our, some of those are first time, but maybe 450 is a move up, from 300. As far as the change goes, right, we were kind of already looking at the change in the market share, but let's look at the actual percentage change. So here again, no surprise, unfortunately, we see declines in showing activity in our most affordable segments, notably under 300, especially under 2. Where do we see our biggest gainer? Looks like 400 to 500, so 400 up to 500,000. Witnessed a 75% jump in showings. Million plus, nothing to sneeze at, still 17%, and then 600 to 800,000, also 55%. So we are showing some strength in these mid-market ranges, but also some luxury ranges. We are still showing weakness in our most affordable ranges. That has been the case, and I expect that to be the case for some time. So as we're talking about leading indicators, one other one to watch is the Mortgage Bankers Association refi index, right? So as you see more, so look, here was the kind of bubble of 01 after that kind of crashed. Rates did what they did, and look at 07, 08, rates kind of plummeted, and we see all this activity, and then there's COVID, and we see this surge. And the reason I'm showing this to you is because it looks like, well, it looks like at least a lot of that short-term spike from COVID, could be sort of petering out a little bit. I wouldn't say mortgage applications have plummeted. I wouldn't say they're at low levels, but they are clearly off of these peaks. And you can kind of see these spikes when there's, something happening in the market, whether it's really good or really bad news in the market, or, if there's a big change in interest rates. So just a word on that. How about new listings week to week? Biggest gainer is luxury, right? 3/4 of a mil up to a mil. Second biggest gainer is 1/2 a mil up to 3/4. But overall, we were down about 11% because we have losses in all these other segments, right? So, as far as seller activity, we couldn't even put up a plus sign for 250 to 350. We didn't have more sellers than we did 2 years ago. We did have 9% more sellers compared to the same week 2 years ago for 350 up to 5. So it's pretty clear to see a little bit of a pattern here, right? It's kind of like a sine curve. It's kind of beautiful. Data is beautiful. Been telling this to you guys for years. Changing pending sales by price range. Biggest loser, down 82%. Wow. Turns out there just isn't that product to write offers on. So you don't show gains in pending sales in signed contracts. Biggest gainer, 70% surge in signed contracts between 3/4 of a mil up to a mil. Second biggest gainer, 1/2 a mil up to 3/4. Even though overall that was down about 1%, 1.33%. Oops, did I say new listings, guys? So that was pendings. Just be careful. So we did new listings for the week, then we did pendings for the week. Now let's do new listings for the month and then pendings for the month. So this is November data. We just released this this morning. We had a press release this morning where we sent out numbers to Strib, NPR, KR11, CCO, Fox, you name it. And they get to tell their story and write their story and inform their readers. So it's always fun times. So change in new listings here again, we do show this biggest gain in 5 to 750, along with losses, in the usual suspects here. So how about pendings? Wow. 114% jump in signed contracts over $1 million. Gee willikers, right? That is quite a figure. What does that come to? 56% per year, 56.5% per year. That is significant. Even, doubling, more than doubling, up 100% here as well over 2 years. So about 50% per year. But overall, we're only looking at about 13%, which is 6.5% per year. But just note, we've got some pretty notable losers and some pretty notable gainers on the demand side. Okay, so let's shift gears just a little bit. Shifting just a bit, let's look at some seasonality trends. So we know that last year was wonky. We know that 2020 was wonky. We can see how 2020 new listings really flattened out exactly when most other years peak, right? So look, 2020 actually started off really strong for seller activity, right? We're looking at new listings. Started off pretty strong, flattened out after COVID, and you can see it kind of stretched past where we usually have a seasonal slowdown, right? That means that comparisons in 2021 back to fall of 2020, well, that's not really apples to apples because 2020 was leaning, it was skewed, right? It wasn't quite here, it was more kind of over here. Most years are right here. So just a word on why some of our comparisons can look a little wonky. So 2021 here, right, looks like, wow, we're well ahead of 2020. And then over here, it's like, okay, oh, wow, we're below 2020. It doesn't have that much to do with this year as much as it has to do with last year. So just be careful. Here is another fascinating one, just so amazing. Pending sales, last 4 years, 21, 2019, and 18. So here again, we have that same skew because spring market, because of COVID, spring market was delayed and kind of became summer market. And then, even obviously stretched into fall market, right? Look at getting into October. It's been the highest it's been in 4 years. So, here again, we see this kind of flattening out in spring, and that's at a time when we usually, kind of peak. Maybe it's a little more like summer, right? May, June. But, last year we peaked, what? August, September, and remained pretty strong for a while. So here again, you guys, 2021 pending sales, right? Looks like we're well above 2020. How about nowadays? 2021 pending sales looks like we're below 2020. It's not this year that's wonky, right? Look at 2021. It's not this year that's that wonky. It's last year that's wonky. And that's rendering some of our comparisons, well, it's making those look wonky too. All right, folks, when it comes to data analysis, you excel. Got to have some fun with it, forgive me. Okay, affordability index. This is sort of a brainy one. So, I just kind of think about higher levels or higher affordability. Lower numbers correspond with worse affordability. So you can see 06, 07, peak of our bubble, affordability was relatively low. The market crashed, right? Foreclosure and mortgage crisis, and rates went down, homes went on sale, and affordability soared. Affordability really hit peak levels over the last 20 years. Then we saw affordability start to decline. We saw some gains. What's going on there? Incomes are up and rates are down. And so that's actually boosted affordability. Now, well, that's through last year. So that doesn't include this year. But let's say we're thinking about a $340K median price and a 3.5% fixed 30-year. Well, that would bring us to 128. But maybe in a couple years, or maybe 2 or 3 years, if we hit 360K and we hit 4% on the 30-year, that would put us at about 117, which still isn't as low as affordability was back in the bubble days of 05, 06, and 07, but it is getting there, right? It is getting there. How many of you, I'd like to ask this question, how many of you woke up today thinking you'd see data going back to 1967? I bet not that many of you. So this is the ratio of demand to supply, right? Closed sales to new listings. You can see when the economy is in trouble, right? Hyperinflation and recession in 81, 82, demand plummeted relative to supply, right? 07, 08, look at this. Look at how low demand plummeted relative to supply. Look at how much our market has tightened up. For every 100 new listings, we have about 84.5 pending sales, right? I'll say that again. There are about 84, 85 signed contracts for every 100 new listings. That is as high as this ratio has been since 1967, right? Now, that's saying something. That's a powerful statement. I wouldn't say it's light years ahead of where it's been, but it is, it registered, above. So it just speaks to, exactly how tight the market is. And it is, by this measure anyway, it's about as tight as it's been since 1967. Okay, friends, let's take a look at some of our sort of typical, usual suspects, standard fare metrics here. So let's cover new listings. So this is just November. This is November of every year, right? November of 21, November of 17, November of 03. And we're kind of looking at, the increase, the downfall, and well, hard to call this much of a gain. Maybe it's slowly falling upwards or slowly dripping upwards, but we need to see higher figures here. We need to see more seller activity. I mean, I used to say, I don't know that we belong up here, but now, sales are all the way back to there, and population growth has only, been consistent and persistent. So, maybe we need somewhere closer to, 5.5. But you guys can see we're just nowhere near there. At least we're off our lows, I guess, if you're really reaching for a positive. Pendings, right? Just bonkers. November pending sales. Oh, almost. So 4704 last year, that was up 15%, but fell 38 shy of our all-time high for November, which was of course in 04. Here's what's so fascinating about this plus 15%. For a lot of our other months, we didn't sustain that, right? We just weren't able to sustain it. So we came down a little bit. What's so interesting now with this November data is, and I'm frankly a little bit surprised by it, I expected us to be ahead of 19, but I didn't expect us to be ahead of 2020, just because of how 2020 went and the great frenzy and the great shuffle of course, brought on by a pandemic. So, really signifies strong demand in the market. Buyers are still excited. They're still amped up and ready to go. And I am impressed that they put up, even a 1% gain. I'm impressed at that. So signed contracts, buyers still pushing the envelope here. So closed sales, this is a little bit more like what I would expect. 61%, wow. Must have been a tax credit back then in 2009, 2010, if you guys recall. So, been on the up and up here. There's our 20% pie in the sky, last November, and we only came down 2.5%, right? So look at how many of those gains we sort of sustained. We were able to sustain a pretty good portion of that gain. And as you guys can see, it looks like sales activity, at least closings, were kind of leveling out a little bit. Then, golly, did we have a spike? And we've sustained most of that increase, which also is impressive. So some of this, don't forget, signed contracts are a better leading indicator for demand. Closings reflect, sometimes closings reflect just how much volume, how many files can hit the closers every day, right? Can hit the title and hit closing, hit the closing table every day. So sometimes we see some bottlenecks there. I think those folks in that sector have gotten a lot better, and it shows in the numbers. Market time, 16 days, that was up 6.5, almost 7%. We're talking about one day. We're talking about a day from 15 to 16. Still remarkably fast, especially, when you benchmark that against 115, 100, 114, 90 days, all the way down to 15 and 16. So safe to say, homes are selling quickly. It also speaks to the game of musical chairs idea, right? If I'm a seller, I've got tremendous confidence in my ability to sell a home quickly and for top dollar. I'm tremendously confident in that. What I'm a little bit less confident in is my ability to secure the next home, right? That's at a reasonable payment, in a location that I want, that has the kind of square footage and bed bath, counts that I want. So just a few notes there. Median sales price, let's make sense of the dollars here. So November alone was $339. I think for the year, we'll probably be at about $340. I think we'll end up at $340, which will be a nearly 10% gain. But remember, that includes first, second, and third quarter of this year. So, still 9.5%, pretty notable. Almost 11% last November, also pretty notable, especially when you think, 4.5, 7, 6, 6.5, okay, 8, 5.5, whoa, 11 and 9.5. So clearly price growth has accelerated, and that has registered in the data. Just a quick note on price acceleration and deceleration versus price gains and price declines. These are different things, folks. Price gains, long as you're positive, you're golden, right? Price losses, price declines, you have to be going from 300,000 to 290,000, right? That's not what we're doing. And I think some people are getting the wrong idea. What we're doing is decelerating. Price growth used to be 16.5%. Now it's 8%, right? So it looks like peak price growth. We hit we hit peak price growth in May of this year when prices rose 16.5% from about 295 to about 345. So a pretty significant month. But you guys can see, right? 16.5 down to 15, down to 12, down to 11, 10, and now kind of down to 8. This is a good thing. 16% is not sustainable. It is simply not sustainable. So it's a good thing, as we start to settle back into, I don't know, some people say 4 to 6%, 5 to 7%. Some say 3 to 5, but I think we'll get back to 4, 5, 6%, and that is much more sustainable price growth. Yeah, this has been a fun one to kind of check in on. Here's our 16.6% pie in the sky, which actually matched some of the price growth we saw as we were coming out of the Great Recession there and out of the crash. And you guys can see, right? These blue bars are higher than these blue bars, right? So minus this kind of early phase of our recovery, this is an anomaly. Clearly, it's an anomaly. However, I do think we're kind of starting to get back to 4 to 6, 5 to 7% growth slowly. November percentage of original list price. So very simply, that ratio of sold price to list price. If I ask 300,000 and I accept 270, I just accepted 90% of my list price, right? Because minus 30K is 10% of 300, so I accepted 90%. Sellers are getting 99.8%, so just about 100%. That is down from last November, no surprise, when sellers were yielding or realizing about 125%. I want you guys to note, that is ahead of bubble levels of 03, 04, 05 levels. Don't you guys love how this metric should have tuned us into some trouble earlier on? I was not here. I didn't arrive here till 2010. So don't throw virtual tomatoes at me. But, as we started to see this kind of decline, maybe this could have been an early warning sign that, sellers are getting a little bit less offer, buyers are pulling back a little bit. And so, maybe that could have been a little bit better understood, but hindsight is 2020, or is it 2021? Well, whichever. Okay, June percentage of original list price. Let's tease out June, you guys. Look at this, 104.25. And I think even more interesting is, look, 100.3 down to 100, down to 99.6. So it looks like this indicator was beginning to soften. At least flatten out, but there's evidence here that it was beginning to soften. And then, wowee, did we just put up an extraordinary figure. November inventory. We don't need to talk about inventory because there's plenty of it, right? I think that joke is getting old. I'll retire it shortly. So active listings, you guys, we were down about 18% to 6,200. And at one point, believe it or not, we had 32,500 listings under active status. We are looking at a nearly 80% decrease in supply, nearly 80%. Let me pause here. I've got two important notes. One, if a listing comes on the market on November 10th and it goes off market on November 20th, guess what? That will be counted as a new listing, but it will not be counted as inventory at month end. Inventory is a snapshot. It's a snapshot of the properties listed under active status at month end. Because that listing came on mid-month and went off mid-month, or came on after the first and went off before the end, before the 30th, that won't be counted. So, that is inventory. At one point, it was an active listing, even if it's not active at month end. So, this is how we've always calculated it. This has been our methodology for a decade and a half or so. But, just know that that calculation could be leaving some out. Another note, we do appear to be undersupplied. What about technology? Technology really has sped up the process. So it's almost like we have an inventory shortage at any moment. Excuse me. We have an inventory shortage at any moment, but maybe not as much overall. Does that make sense? So these listings come on and go off so quickly that there's not much sitting inventory. But, there obviously are listings out there, or we wouldn't see demand soar to all-time highs. So just a few notes to think about, as we're thinking about inventory. Month supply, 1.1 months. That is not very much. We need, call it 4 to 6 months of supply we're looking for, and we have nowhere near that. So another thought here, and I actually have a slide on this, but let's, I know some of you are concerned about forbearance, for example, what's going to happen. A lot of those loans are getting, loan mods, they're coming out of delinquency, they're getting current. So, a lot of that side has healed, has gotten better. But even if we were to see an increase in listing activity, and it doesn't really matter if it's existing, urban, suburban, new, foreclosure, condo, with this kind of absorption rate, it's gonna get absorbed. And there's no way it could shove us, above 4 or 5 months. So even if we did go to 1.5 or 2, the demand is so strong in this market, and the consumer is so healthy in this market that, on average, obviously not everybody, but on average, you know, we're on average, we're above average compared to other states. And so even if we were to have an increase in supply due to forbearance, you know, that would not unravel our market. I will say, you know, I'm going to climb way out on the skinny branches again, and I'll say I do expect a little bit of an inventory increase next year. Just because, well, I think demand will still be strong, but I think it'll be flat. I don't think we'll show these huge gains, just based on what's going to happen with interest rates, with Jerome Powell, you know, making announcements on tapering and stopping some of the bond purchases to try to normalize rates a little bit to control some of the inflation that we've seen. So I do think we'll see a little bit more inventory. So we're looking for more seller activity. And if we get that and buyer activity is flat, I don't want to say we want demand to be down slightly, but even if demand were to soften a little bit, which would not be the end of the world, it would put the market, you know, it would move us back toward balance. And that's really what we're after. Here we are in a seller's market. We got a lot of buyers, but not a lot of homes. Buyers markets, a lot of homes kind of chasing buyers. Balanced market, is this so much to ask for? We're looking for our housing supply to be relatively well matched up with our housing demand. It seems ever elusive. You know, I know I've shown this for the past maybe 2 webinars, but I think it's important. I just want us to know, this is the Case-Shiller data. So every data point here is price growth on the Case-Shiller axis here, and then month supply change, or excuse me, month supply levels, and that's from NAR over on the left axis. So what is this telling us? Look at the clustering here. There is such clustering in undersupplied markets with rising prices, right? There's a good amount of data points in oversupplied markets with falling prices. Pretty interesting. There are some oversupplied markets with rising prices, but there are no undersupplied markets with falling prices. And we are grossly undersupplied, right? We have 1.1 months. Now, this is national. This is national. That's not to say that some local markets haven't broken this trend, but just know there is a relationship here where, you know, undersupplied markets tend to have rising prices and oversupplied markets tend to have falling prices. There are some outliers, but just know this is kind of a pattern, and this is relatively rare to see. Not impossible, but relatively rare. Let's take a look at year to date. So year to date, we're still down about 0.4% to about 73,000 new listings. You know, I guess I'd call both the number and the change a little bit disappointing, right? So 72.9. Yeah, just barely ahead of these 4 years, which is not really saying much, because as you guys can see, that was really our valley, right? That was really our valley. So we, you know, okay, fine, barely registered an increase in 2019, but, you know, we have been flat for so long. It's just been a little, it's been a little frustrating, I know, for a lot of you out there. We've been, I mean, look, we've been between 70 and 75 for for going on 9 years, right? So need to get a little bit up on that ladder there. How about on the sales side? It looks like we'll be up about 3% to 61.2. And you guys will note that is the highest level. So that is a record year to date. And I expect we'll make a record for year end. Brian, no polls. This is not for CE credit. This is just a fun webinar you came to learn more and improve and sharpen your skills. But I do appreciate the question. So November year to date, you guys, here's what's important. We have 92% of the year in the books, right? We have 11/12 of the year, 11 out of 12 months of the year in the book. So this is a pretty sticky number. This has weight to it. This is going to stick. It's not going to change a ton. You know, we'll add 3,000 or 4,000 sales for December, or maybe 2,500 or 3,500. But I think we will still have this very similar, you know, plus 3%. And I still think we'll keep that all-time high. So demand, I'm almost certain saying demand will have reached an all-time high this year in 2021. Median price, like I said, looks like we'll be up about 11.5 to just about 340. On the negotiations front, right? How much of the asking price will buyers offer to the seller? Remember, spring and summer of this year were pretty red hot months. So, even though, despite some winter months in there, obviously, we will clearly end the year over 100%, maybe 101.9 or 102 flat, because December is always a little bit lower. But I'm running out of the adjectives. I mean, this is astonishing, that, on average, sellers got 100% of their original list price, not current after a price reduction, but original. They got 100% plus 2.1% on top of that. Yeah, I mean, you guys can see it's really, it's a pretty crazy number. Okay, let's get into some price reduction analysis. I love this stuff. Well, I love all this stuff. I'm just very pro charts. Okay. Percentage of sales with a price reduction, annual figures. How many of you guys realize that just about 50% of our deals required a price reduction in order to go under contract? That has fallen to about a quarter, right? 25% at least last year. How about August through August of this year? Or excuse me, not through August. This is August of every year. So this is just August. So, here again, a couple months ago, we still see declines. That's positive. We're not seeing an increase. I want to point out, even though we saw an increase here and we did see a little increase here, the world didn't fall, right? The sky didn't fall. The world didn't come to an end. October, interesting differences here. So August, October, I did register a very slight increase. Right, I did show a very modest increase from 21.4 to 23.5, nowhere near the 30%, that we were sort of in the pre-COVID years, I guess I'll say. But I did register a little bit of an increase. I think that's notable. Just keep that in our back pockets. How about November? So that was October. How about November? Similar story, guys. I did track just a little bit, 1.9, right? Not even 2. So 24.1 to 26. Not a ton, but, not necessarily in a direction that you'd hope to see. Although maybe you're someone who thinks prices have gotten a little out of control. And maybe you do want to see some price reduction so your clients can get into something. So, I guess it's a matter of perspective. Two sides. Actually, there's 3 sides to the coin: his side, her side, and then the truth. Okay, percentage of sales with a price reduction, sticking on this indicator. Let's tease out November. So November of 19, 35.9, November of 2020, 24.1, and then, like we saw, November of this year with 26. I also want to point out the pattern here. So look at the pattern here, guys. You see a normal sort of, normal U curve here. You also see a normal U curve here. Look at 2020. 2020 was a W. We actually saw price reductions heading into September, something that we just never see. Okay, now, so that was the basics, you guys. We covered the basics. We've given you the data that matters. We insist on doing that. Let's move into some fun stuff, shall we? 8045 West Bush Lake Road. Owner, Zillow Homes Property Trust. It's active at $399.9. Huh. What's going on with this guy? Okay, so forget all this stuff. That was prior sale, but here, okay, so it's incoming. It's active at $475.9. We dropped it to $469.9, and then to $459.9, and then $449.9, $424.9, $419.9, $414.9. Finally, we threw in the towel and they dropped it below 400. Interesting. Let's get back to that in just a second. So cash deals as a percentage of all sales, and it's not a coincidence. I just showed you some Zillow trends. Cash used to only make up 4 to 5% of our market. After the market crashed and everything was on sale, it made up, anywhere from 20 to 23%, or, call it 15 to 23%-ish of our market. It's come down a bit, but has remained elevated. And I think that has to do with some institutional buyers. I think that has to do with folks treating residential real estate as an investment vehicle, as an asset class. And I mean, can you really blame them if it's yielding you, 10, 11, 12% per year, and it's cash flowing, so it's an appreciating asset and it cash flows? What more can you ask for, folks? So, come down, but remained high relative to pre-bubble, or I should say maybe bubble levels, pre-crash levels, I guess I'll say. I just mentioned investors. Guys, no one's demonizing anyone. This is just a trend that we're pointing out. We are not throwing anyone under the bus. We, like it or not, we still got a mostly free market. So, he or she who has the capital gets to buy the thing. You got the money, you buy the thing. But Strib had an article on this. I think Business Journal did too. It looks like, and the Federal Reserve just released a new tool that really dives into some of this stuff, and it's pretty cool. Take a peek if you haven't. They show, I don't know, it's only like 4% are investor owned, institutional or investor owned, which doesn't sound like a ton. In parts of North Minneapolis and Northeast Minneapolis, it is as high as 30 or 40%, which is pretty high. That may not be as much of a concern when inventory is plentiful, but given the scarcity, situation we're in, I think people are paying a little bit more attention to it. So no one is a bad guy. There's no one's bad here, just pointing out a trend. And if you really do look, this has been, a very much an increasing trend. So investors bought up a record 90,000 homes in the third quarter. Many of them sight unseen, by the way. You saw them kind of pull back, after COVID, but then they realized, wow, this market is heading upwards. Let's be part of it. Let's get a piece of the action. I would be remiss if I did not mention inflation. We've had a couple months of multi-decade high inflation readings. I guess a couple thought, well, let's see, we're 243. I don't know that we have time to geek out on that. But I will say, inflation has been running below average for many, many years. The Fed's target was 2%. It's been 2% for a while. Inflation was 0.8, 1, 1.2, 1.5, 1.6 for a long time. So it was well below. And now it is significantly above. So, I think sometimes the numbers seem worse than they are. And remember, food and energy and housing are very volatile categories. Clothing and I don't know, technology. I know used cars have been driving that up as well. As well as housing. So there's a lot of different components to that. Just so we're kind of aware. So there's two ways to look at this, guys. Two ways to look at this. Let's look at implied home price in $2003. So notice that our nominal home price and our implied home price, they both start at the same exact point, right? Because there is no inflation adjustment if you're in 03 and your nominal in 03 and your real adjusted also in 03. There is no adjustment. As time goes on, look at nominal home prices in red, right? This is what we're actually paying. These are the numbers that we're seeing, right? So that's nominal home prices. That's what's happening out there in the market, in the community. Look at implied home prices in blue. So this is real or inflation adjusted home prices. So look at what inflation has done. And again, this isn't just the last couple of months, you guys. This has been for a while, even though it hasn't been that high until the last few months. It compounds continuously, right? It's 2% on top of 2% on top of, so over time, we do see this divergence. Another way to look at this, and I guess in some ways I kind of like this better. Now let's frame it in 2021 dollars, right? So here the two lines meet up at the present day, right? Because there's no adjustment because we're looking at 2021 dollars. If we use today's dollars and we sort of forecast, or I should say, we reverse extrapolate, we forecast it backwards, take a look at where the implied home price would be. It wouldn't be here, right? Here we were paying in 2006 dollars. Look where we'd be if we were paying in 2021 dollars. So, I think that's important for a couple reasons. And one of the big ones is, and I think you can actually see it better here, look at blue, right? So look at red. Red is way ahead of its previous peak. But look at blue. Blue is actually not ahead of its previous peak. So when we talk about real inflation adjusted home prices, we're actually not that ahead of our peak, which tells me, we do have some room to run. We've got some runway ahead of us. Okay, million plus. This is the big bucks, baby, right? So million plus in August, 51% jump just in August. October, I did register a very slight decline, down 12%. However, 123 in the context of every October back to 03 is a ridiculously high number, right? Even though it's down, it is still absurdly high. How about November? I am back to gains. I am showing gains again, up 21% to 115, way above the bubble levels. Pretty interesting data here, 39, 39, 39 for all those Novembers. And then you guys can kind of see the trend from there. Year to date, so for the 11 months here for the 11 months so far in the books of 2021, missing just December, we're showing that 43.33% surge, I'll call it, in million plus deals. There's not many ways to say this, guys. High net worth individuals, good for them. I think a lot of people admire that. High net worth individuals, guys, they've got the capital to buy anything, anywhere, right? And so they are indeed deploying that capital, trying to get some more, a little bit more space for a home office, maybe a first or second home classroom, wanting some, maybe sport court, I don't know, some outdoor space for pets and kids, because COVID and because personal space and because single family and because America. Okay. Just a note and a little bit of a joke. Sometimes you guys over nurturing and pushing a market past its maturity date can actually be harmful too, as this pregnant unicorn will remind you. All right, spoon and cherry, real quick, guys. Let's do Minneapolis, just real quick. Urban market share, percentage of our metro-wide sales that are happening in either Minneapolis or St. Paul. Condo bubble, look at our condo bubble, 08, 09. Of course, a ton of activity was happening in the core cities because that's where our condo bubble was. Okay. Take a look at this, though. We saw urban market share fall, and look at when COVID hit, right? Here, there's that March, April. We saw urban market share decline, and then we saw it increase. The percentage of Twin Cities sales that are happening in Minneapolis and St. Paul is at a 6-year high, right? 6-year high. I don't think many of you would have assumed that. And clearly the media doesn't understand that. But that's the fact, whether we like it or not. That's the fact. And facts matter. Someone said we're living in a post-fact era. God, that drove me just crazy. We are not living in a post-fact era as much as some want us to be. Change in new listings, Minneapolis in blue, are many wonderful suburbs in orange. Look at the increase in Minneapolis listings. Wow. Closed sales. Look at the increase in Minneapolis sales. Wow. Right? So, taken in, if you take this in isolation, oh my God, look at all these sellers in Minneapolis. How come we didn't see those in the suburbs? Well, we also saw far more demand in Minneapolis than in the suburbs. So there was a higher rate of churn or turnover, but there was not an exodus or a flight from the cities. Again, those are the facts. Facts matter. Days on market, we do see Minneapolis homes taking, well, actually, it's still, the trend line is still on the decline, but you'll notice it's getting back towards zero. And the raw data behind it actually did register an increase. Look at the suburbs, though. See this orange kind of, it's a little bit lighter. I don't know if you guys can see that, but it looks like the suburbs are following the city, right back up. Let's skip that, just a little comment. Suburbs, square footage, you guys, why the interest? Well, I need more space, right? 1980 square feet versus some of the lovely, charming, cozy homes in the city at about 1,500 square feet. Price. The money. Minneapolis, prices still rising. but to a lesser degree than they are in the suburbs. And if you look at the data behind, it looks like both are kind of coming back down to earth a little bit. Percent of original, similar story. Suburbs, city changed a little bit. Looks like the suburbs are getting ready to change. And then here's one that we do pretty much every week. The percentage of active listings under 250. And of course, we break this down by each of our beautiful urban areas as well as the region as a whole. Interesting, see a little bit of an increase in affordable units in Minneapolis. Pretty interesting. Rates slowly crawling up to 3.12. Nothing astonishing or extraordinary. Although, as we talked about, I do think the Fed is going to start to normalize rates. That would mean if I were a betting man, I would bet on these going up. Let's remember, anything below 8% is a historically attractive interest rate. And I can say confidently, we will be below 8% for years to come. I'm pretty confident saying that. So what are these rock bottom mortgage rates doing for us? What are they doing to the market? Well, check it out. Median home price, so just the sold price here in dark blue, peak of the bubble, 0506, even higher than that today, continued its ascent. And then look at mortgage interest rates, right? So they all start at the same level, but look at the change in mortgage interest rates. So even though prices have been rising, rates have been falling. And so look at what that's done to monthly homeowner costs. Monthly payments aren't actually really above their previous peak. Now, this is national data, which includes data from rural Louisiana and Nebraska and West Virginia. Nothing against those places at all. I'm sure they're lovely. But homes cost 80 grand there versus 350 here. So just be aware of that. iBuyers, what's going on here? Net profit, net loss per home. Open Door, okay, not doing so bad. OfferPad, all right, not doing so bad. What is going on with our friends at Zillow? Wow, looks like some missteps there, doesn't it? Yeah, looks like some poor decision-making has resulted in some unfortunate business results. And that is what we see. So, when you look at gross profit margins, again, Open Door and OfferPad and Zillow coming in a little bit behind the pack. Just sort of similarly, look at the median purchase price. And I know this is Phoenix. I am well aware we do not live in Phoenix, especially if you've been outside in the last 5 days. So look at the market in yellow, Open Door in blue, OfferPad in black, and look at Zillow in pink or magenta, or whatever that is, right? As things started to change a little bit, right, some of these other iBuyers actually started to hunt for deals and they weren't overpaying. It looks like Zillow continued to pay top dollar. And, I think that's a big part of what got them in trouble. Okay, housing units under construction, time check. Oh God, we have 5 or 6 minutes. I gotta hurry here. So here's the question. Is single family construction sort of finally catching up to single family demand? Huh. 1 unit single family in red. Wow, we used to be so single family dominant, right? And then look at 2+ units. Kind of catching up, right? So multifamily catching up. And actually, right, multifamily was running ahead of single family development. And then, here again, look at our 1 unit. I think people kind of got the hint, right there, middle of 2020. You can't make this stuff up. Our builders really started making some of those investments back into single family. There's still a lot of multifamily development. There needs to be development of all kinds across the board, across the metro, across the country. I do find this interesting just to compare kind of red and blue here and not in a political sense. Okay, from our Mortgage Bankers Association friends, taking a look at percentage of service portfolio or of servicing portfolio volume in forbearance, right? So Fannie Freddie, portfolio loans overall, this is heading in the right direction, although it's not all the way back yet. Ivy Zellman, very smart lady who called the housing crash last time. The likelihood of us having a foreclosure crisis again is just about 0. I could not agree more. Average equity gain last 12 months, about 33 grand. I'm still mad that Indiana beat us with 35, those Hoosiers. But, you guys can see in our upper Midwest neighborhood, we are, we're kind of the leaders here. Friends in California and Washington gained over 100 grand in housing equity over the last year. Not too shabby. All right, just two more here, guys. Mortgage rate projections. I think we covered this one last time, but 3.17. We're in fourth quarter. That's about where we're at. I think we're 3.12. So into early next year, 3 1/3, getting to just under 3 1/2, and then just over 3 1/2 by, late summer, early fall next year. Estimated home price change, so this goes, this is 2021, 22 through 25. So you guys will see, right? And this is probably right on for us. I think we'll be maybe 10 1/2 or 11, maybe 11.2. So I think that's actually pretty good for us. I think that's pretty accurate for us, I should say. Whether it's good or not is a different question. Moving forward, guys, just like I talked about, 3 to 5, 4 to 6%, kind of a little bit more stable, steady and sustainable price growth. So this is for just next year, right? So average of all forecasts, they're thinking about 5%. That's right in the middle of a 4 to 6% range, or happy little range. Interesting, see the government agencies a little bit more bullish, and then NAR and our friends at Zelman a little bit more bearish. So it's quite a spread here, right? 2.8 to 7.4 is quite a spread. The answer, as usual, is somewhere in the middle. And that I do mean to apply to our political dynamics as well. So average, just about 5%. And with that, my friends, I will stop in the name of love and open it up for any Q&A. Anybody at all? Any questions at all? Let's take a look. Let me go back through our chat here. Ooh, looks like Jeff Kendall has got a little thought. So, okay, is it true first-time home buyers are up in 2021 over 2020, maybe 3 to 4%? If so, will 2 or 3% projected interest rate hikes slow that segment? Jeff, I think you're spot on. I think that as rates rise, it's going to affect those at the bottom much more because it impacts their ability to pay. And of course, budgets are tighter. Inflation is a regressive tax, meaning it impacts those the most who can afford it the least. So, I do think you're spot on. I was just in an NAR forecast summit yesterday with Dr. Lawrence Yoon, chief economist of NAR, and then Dr. Jessica Lautz as well. And they released data. I don't have the report in hand yet, but I do remember them saying that there was an increase in first-time buyer. I just can't quote you the figure. It might be from like 31 to 32 or 30 to 31%. Let me find that for you, Jeff, and I can follow up. That unicorn graphic was pretty graphic. Thank you, Ruth. I appreciate that. You got to have some fun with it, you guys. Otherwise, you got to have some fun with it. Other thoughts, questions? We're hoping this is still useful for you guys. Just a little monthly check-in, a way for us to take a look at what's happening in the market, especially as, we might be smelling some changes, might be sensing some shifts out there. All right, 2:59. We are right at time. I want to thank you guys so much for joining us. Really, really grateful to have you guys with us and for sticking it out to the end. Please do join us next time. And thank you, Natalie. Natalie, you're terrific. Thanks for joining us. And I will talk to you and see you, within a month and a week or so? Very much looking forward to it. Thank you guys so much. Hope to see you all and talk to you all soon. See you next time.